Hello, and thank you for tuning into our first video here discussing the Chapter 7 homework for Survey of Accounting. Our first question, we're looking at a note payable where the company borrowed $141,000 in this example from the bank on October 1st. The note had a 6% annual rate of interest, and it matures on March 31. So we have October, November, December, January, February, March. So we have a 6-month note payable. We're not actually covering a full year. So let's take a look at what this looks like on a timeline and take a look at our questions that are associated with this assignment. So in October, we borrowed the $141,000. So the first question is, what amount of cash did Abdrin pay for interest in 2018? Well, they're not going to pay any interest until they actually make the payments that are required under the terms of the note. They're going to pay back the principal of $141,000, and they're also going to make the payment of interest here at the end of the loan. Here you can see that I've calculated the interest for 1 year, which is $8,460. This particular note payable is 1, 2, 3, 4, 5, 6 months. So the payment required is only going to be half of 1 year, or $4,230. But that payment of interest is not due until March 31, 2019, when the loan actually matures. So the interest that we're going to pay in cash in 2018, that's going to be zero. And then we get on to question 2, or part B here. What amount of interest expense was recognized in 18 on the income statement? Well, the other element here that we could look at is the interest that's actually accrued. So we can look at the $4,230, our total interest that we're going to pay over those 6 months, and divide that by 6 months to see that we're going to have $705 in accrued interest in each of those months. So the interest that was recognized in 2018, we have 1, 2, 3 months. So we have 705 times 3. So a grand total of $2,115 in interest expense related to 2018. What amount of total liabilities was reported on December 31, 2018? Well, for that, we would look at not only the note payable that we borrowed, the money that we borrowed from the bank, but also the interest payable, the interest that was due to the bank, even though we haven't yet paid them. So the liability for the note payable, as well as the liability for the interest that's been accrued. So at that point, we would have a total liability of $143,115. What total amount of cash was paid to the bank on March 31, 2019 for principal and interest? Well, we've done the math already right here. We said that our total principal payment was going to be $141, as well as the interest for 6 months, or $4,230. That's going to be our total payment that we're going to need to make at the end of the loan term. What amount of interest expense was reported on the 2019 income statement? Well, we had a grand total of $4,230 in interest expense. We have $705 each month. We already figured out that these 3 months total up to $21.15. So these 3 months are also $21.15. 3 months that relate to the 2019 year. So those were the couple of questions there for question 2. Let's go ahead and take a look at question 2 here. We have a chair company provides a 120-day parts and labor warranty on all merchandise it sells. The company estimates that the warranty expense for the current period is $1,220. So let's take a look at how we would record that in our framework. The estimate of the warranty. So we're expecting that we're going to have to pay $1,220 in warranty expense during the coming period. So to set that up, we would have our liabilities would increase. Warranty payable would increase by $1,220, and our retained earnings would go down by $1,220 because we're showing that expense, the cost of us furnishing those warranties is going to bring down our earnings. At this point, though, there's no statement of cash flow impact because, again, we haven't impacted our cash account. Cash is not impacted, so our statement of cash flows over here on the side is not going to be impacted by us when we set up that warranty payable. Now, what about during the period a customer returned a product that cost $915 to repair? So that was the repair that we had to make to that product that was covered by the warranty. So at that point, we would pay for the repair, and we'd also reduce our payable because, in essence, at that point, we're working down that estimate. We've made our first repair. We estimated that we were going to have $1,220 in repairs to make. Here we go. Here's one of the repairs that we did have to make that's going to be going against our warranty payable. No impact to our retained earnings. That's all in the fact that account's only impacted when we actually set up the estimate. But our statement of cash flows is going to show that negative $915, and this would be an operating activity, something routine, ordinary that we'd have in the course of do business. So let's take a look then at question 3 here. A partial amortization schedule for a 5-year note payable that company issued on January 1, 18 is shown as follows. So the beginning principal balance was $133,000. We're making regular recurring payments of $34,193. Here's our interest portion. The rest goes to principal. So the first question is, what's the interest rate that the company is paying on this note? Well, how would we figure that out? Let me get over to that here. So the interest, let's take a look at the amortization schedule, and let's look at the interest that was charged for the first year and the principal that was outstanding. So we had $133,000 in principal that was outstanding, and we had interest of $11,970. So if we divide the interest that we had on the note and divide that by the principal, that should give us a rate of interest that is being charged on that particular note. So 9% is the rate of interest on this note. Again, what we're doing, we can do this with any number of those interest and principal payments. Here, the principal balance was 110,777. So if we put that into our formula, 110,777, and look at the interest that kicked off, that was 99.70. Okay. When we look at that interest and principal relationship, we will also see that our 9% stays true. So we can look at that interest that we're being charged, the outstanding principal, the relation of the interest to the principal balance is going to give us our rate of interest. So our rate of interest for this particular loan, this note payable, is 9%. Using a financial statement model like the one shown, record the appropriate amounts for the two following events. So we're going to go back to our framework and we're going to look at what happened on January 1 when the issuance of the note actually happened. So we have a $133,000 note. So we have our cash that's being increased when we borrow, 133,000, and we have our note payable that is also increasing by 133,000 because we have to pay that note back. No retained earnings impact, but we do have a statement of cash flow impact. Our cash is going up, just as it was here. And this was from a financing activity because we borrowed that money from a bank, most likely. December 31st, we made a payment on the note. So if we come back up here to our activity, our first payment was made. So we have the amount of cash payment was 34,193. So that's how much our cash is going down, 34,193 for the grand total of the payment. How much of that was principal? 22,223, 22,233, 223. Okay, so the amount of principal payment is going to reduce the money that we still owe on that note payable. And the interest, the cost of us borrowing that money for that period of time, 11,970, is going to reduce our retained earnings, just like any other expense. So we have an expense here in the form of interest, our revenue minus our expenses. That's going to show us the net income impact of that particular transaction. And our cash went down. We're going to segregate this out, though. We have 22,223 that our cash went down by paying back the bank. And then we also have our interest that reduced our cash. However, that was an operating activity. Okay, let's take a look at what else we have here. If the company earned 93,000 cash revenue and paid 55,800 in cash expenses in addition to the interest in 2008, what is the amount of each of the following? So we're going to go back and record that as well in our framework. So we have $93,000 in cash sales. So cash is going to increase by 93,000. Retained earnings is going to increase by 93,000. That was for our revenue. And we had no expense on that line. So we have our revenue minus our expenses, and our cash is increasing by our operating activity, by those sales to our customers, our cash customers. We also paid $55,800 in cash expense. So we have $55,800 in cash expense. And so our cash is going down, our retained earnings is going down. We have just our expense on this line, and our revenue minus our expense shows us that net income impact for that particular item. And our cash going down by $55,800, again from our operating activities. Okay, let's take a break there, and we'll continue on with this exercise in video 2.